All right, let's jump right into it. Today, we're breaking down a trading plan that's built on one single, really powerful idea: radical simplicity. We're going to distill a pretty complex strategy into a super clear, actionable guide that's all about focus and precision above everything else. Let's get to it. So, does this look familiar? You're juggling a bunch of different currency pairs, staring at charts for hours on end, and just feeling totally swamped by information overload. You are definitely not alone. So many traders burn out trying to be everywhere at once. This plan, though, it offers a completely different path. So how do we fix this whole mess? Well, the core philosophy of this entire plan is what we're calling radical focus. It's all about finding that clarity and consistency, not by adding more stuff, but by dramatically simplifying your entire approach to the market. This really redefines what mastery even means. Instead of knowing just a little bit about a lot of things, the goal here is to know absolutely everything about one thing. The author of this plan literally trades just one pair, Euro-USD, for only 3 hours a day. The idea couldn't be simpler. Become a true specialist in a single pair during one specific market session. Real expertise you'll find comes from depth, not breadth. Okay, so we've narrowed our focus. Now it's time to actually learn the language of the chart. Think of this next section like learning to read a map. We have to understand the key landmarks of price action before we can even think about finding our destination.
First things first, market structure. You can think of it as the backbone of the chart. It's that series of peaks and valleys, the highs and the lows, that shows you the market's main direction. And trust me, trading with this underlying current is just way safer and a whole lot easier. It's the path of least resistance.
But here's the thing. Not all highs and lows are created equal. This is where we have to learn to tell the difference between strong points and weak points. A strong low, for instance, is one that had enough power to actually break a previous high. A weak high is one that tried, but failed. Identifying these tells you which side, the buyers or the sellers, has control, and which points are likely to hold or just get blown right through. It's all about figuring out who's really in charge.
Next up, we have supply and demand zones. And you can forget all those complex indicators, because these are the raw footprints of institutional money. These are the exact price levels where a huge, imbalanced flood of orders came into the market, pushing the price away aggressively. Smart money traders see these zones as super high probability areas where the price might just turn on a dime.
So how do we spot a good zone from a bad one? Well, this plan has a very strict 3-part checklist. Number 1, the move away from the zone has to be so aggressive that it leaves behind a price gap, what some call an imbalance or a fair value gap. 2, that same aggressive move has to break market structure. And 3, a lot of the time you'll actually see liquidity, like a double top or bottom, get built up right before the zone is created. All 3 of these have to be there for it to be a high-quality setup, no exceptions.
Okay, great. We've learned to read the map, we understand the structure, and we can spot the key zones. Now, it's time to find the exact signposts that tell us when to actually pull the trigger.
And here it is, one of the core entry patterns of this whole system, the supply and demand flip. It's a classic idea, right? An area of demand, which is support, fails. It breaks. And then it becomes a new area of supply, or resistance. This flip is such a powerful confirmation that control has officially shifted in the market.
Let's walk through a bearish example. First, the market makes a high. Then it pulls back to a demand zone, but the bounce from that zone is weak. It fails to make a new high. That failure is everything. That weak demand zone then breaks, and in that process, a brand new supply zone is created. Your entry signal comes when price returns to test that new supply zone. It's just a beautiful, logical transfer of power from the buyers to the sellers.
Another key signal you're looking for is the change of character, or COCH for short. This is your earliest possible warning that the current trend might be running out of gas. Now, it's not a full-on trend reversal just yet, but think of it like the first crack in the foundation, a signal that momentum is shifting. Now, it's absolutely crucial to understand the difference between a chalk and a break of structure, or BOS. A BOS confirms the trend is still going. It's breaking a major high in an uptrend, for instance. A chalk, on the other hand, is a break of a minor pullback structure. It's a subtle but really vital distinction. BOS means more of the same is coming, while chalk is whispering that a change might be on the horizon.
And now for the best part. We're going to take all of these concepts and put them together into a repeatable, step-by-step daily process. This is where all that theory turns into actual practice. So here it is, your daily routine. It's a top-down analysis that's designed to give you both the big picture context and pinpoint precision. First, you always check for high-impact news. You do not want to get blindsided. Then, you establish your overall bias on the 4-hour chart. With that direction in mind, you zoom into the 15-minute chart to find your key zones. You then refine those zones on the 5-minute for even better accuracy. And finally, you drop down to the 1-minute chart, and you just patiently wait for one of your high-probability entry patterns to show up. This methodical process makes sure that every single trade you take aligns with the market's bigger story.
Look, a great strategy is one thing, but turning it into a profitable career, that takes two final pillars. This is what really separates the consistent traders from everybody else.
The first pillar is unshakable risk management, and rule number 1 is totally non-negotiable. Never, ever risk more than 1% of your account on any single trade. Why? Because this isn't about hitting one massive home run. It's about staying in the game long enough to let your edge actually play out. This rule is your shield. Use it.
And building on that is the daily stop loss. If you lose 2 trades in a row and hit a 2% loss for the day, you are done. No exceptions. You close the charts, you walk away, and you figure out what went wrong later with a clear head. This is not a punishment. It's a circuit breaker for your emotions. It stops you from revenge trading and turns what could be a disaster into just a manageable bad day.
The second and final pillar is practice. Simple as that. This isn't some magic formula. It's a skill, and it has to be earned through endless repetition. The author is so insistent on this. Take one setup, just one, like the SD flip, and backtest it like crazy. Practice identifying it over and over and over until spotting it is just second nature. Because mastery isn't about knowing everything. It's about flawlessly executing one thing.
And we'll end on this really powerful quote from the source material. Find the liquidity before you become the liquidity. It's a pretty stark reminder of how the market really works. Your job is to understand where those pools of orders, the liquidity, are sitting and trade based on that knowledge. Because if you don't, you risk becoming the fuel for somebody else's trade. A powerful thought to leave you with.